And I'll go through with this one last piece, and then I'll open up for questions. The labor, I'm going through this next piece because it's the same idea. Labor, we have time tickets and salary. Time tickets, any time tickets are directly attributable to a job. Any salary is not directly attributable. And so that's direct labor versus indirect labor, and then we'll allocate. So direct labor, that's just your time card. In systems, again, it's not going to be a punch ticket anymore, but it'll just be, I might have a computer and it'll just say, I put 8 hours on job A, 7 hours on job B. And it'll kind of maybe look like this in the system to determine the hourly cost. Then we'll sum it all up. And then what we're going to do here is, what's unique is now it's part of our inventory. So you might remember in your financial accounting that most of the time salaries and labor costs were expensed as salaries expense. And that salaries expense generally becomes classified as selling, general, and administrative or something like that. But now our direct labor has to be capitalized as part of the inventory when we're building the inventory. And so instead of going directly into salaries expense, what we're really going to have is we're going to credit our payable, and then we're going to debit our inventory now. So it's part of our inventory. And then once it's sold, it becomes a cost of goods sold. So any questions here for the direct labor, the flow of direct labor and direct materials?
For the job cost sheet, does the customer ever see that?
No, no.
Okay, so just for
yeah, good question. We generally don't want our customer to know our costs. It's just for us to determine our profitability. Unless, you know, your customer is, unless you want to negotiate rates, you know, maybe it might come up. I've seen it where if your customer says, well, I'm not going to pay more than this. And then you can say, well, I'm not making any profit on this. You need to give me more money or I'm not finishing the job.
Right.
Yeah. Any other questions? Okay, we're going to keep going. And we have our overhead. So the previous two are pretty easy. Right? We had our direct materials, our direct labor. We know that we can trace those costs directly to the product based on our data, as long as we're tracking it well. Overhead's a little more complex. We need to set an estimate. We call the estimate a predetermined overhead rate. That's just an estimate on what we believe the amount of we should allocate to a specific overhead to a specific job. That estimate is arbitrary in this book. In real life, we're going to try to make a reasonable estimate, but in the book, they'll tell you what the estimate is. And then, so we take the estimated overhead costs divided by the estimated activity base. What do they mean by this? Estimated overhead costs, that's how much we expect our overhead to be in the period. And our estimated activity base, that's the hours or the amount of hours we expect in the period. So the idea here, let's say we think all of our overhead is going to be based off direct labor hours for the year, right? The complexity here is that we don't know how much it's going to cost us in reality, and we don't know how much hours we're going to use or how many hours we're going to use, right? We also, for the project, we don't know until after the fact. So we're making some predictions. And so we'll not only make those predictions based off of previous rates, so we're not going to make it out of thin air, but we have to make an estimate. And so they might say here, well, we estimate that for the month, we're going to have $120,000 in overhead costs, and we're going to have 240,000 hours of labor. And so, okay, we're going to assume that it's 50 cents per hour of labor. And we can make up any of those. We can use overhead costs, will just be an estimate, but the activity base could be anything. It could be hours of labor, it could be manufacturing hours, it could be units produced. You know, whatever gives us the best correlation, whatever we think best represents the facts. And then we'll just multiply it by job. So we'll say, okay, job A had 100 hours used, so we'll allocate $50, and so on and so forth. So we set the predetermined rate, we apply it to the jobs, and then at the end of the month, we get actual overhead, right? We'll actually find out, oh, we thought that we're gonna spend $120,000, but we actually spent $140,000. So we underestimated by 20,000, or sorry, 40. So then we'll take that 20,000, we'll adjust our overhead in cost of goods sold. We'll make an estimate. We'll adjust that cost of goods sold, and then on future jobs, we'll fix it. We'll say, okay, we underestimated, so our new estimate will be 240,000. Divided by, well, let's say our estimate was okay, and so on and so forth. So that's all they're doing here. They used a predetermined overhead rate based on direct labor costs to apply overhead to jobs. And the example is written below, so you can just follow the example here. But I don't want to go in detail because I just walked you through over the theory. You just take whatever the estimate is, we'd apply it, and then the journal entry here would be WIP. Our work in process would be 6720, and our factory overhead would be decreased by 6720. And then we would record the actual overhead, and that's when we'd increase our overhead and decrease our inventory, or vice versa. Factory overhead would increase, factory wage payables would increase. So we under applied it. So if we're increasing our factory overhead, said, oh, we under applied it last period, let's true it up as an expense. And then we record our other overhead costs. We would do it for all of our overhead, our accumulated depreciation, our rent, our utilities, our prepaid. And then the way the summary looks is just raw materials, work in process, finished goods. Again, you're gonna know this, you're gonna keep getting hit with this. Just raw materials, we take the materials inventory, direct materials used goes into work in process, cost of goods sold, cost of good manufactured goes into finished goods inventory, and then we take the beginning balance less the finished goods less the ending balance to get our cost of goods sold, and that goes into our income statement. And then you can see here, this is where our overhead applied goes. It goes in our work in process. And then we'll true up our income statement for the actual overhead. And so they're showing here, I know this is a lot, but just trying to follow the flow. We purchased materials here. Direct materials used went into work in process. Direct labor used went from factory wages payable into work in process. Indirect labor used went from raw materials to overhead. Indirect materials used went from raw materials to overhead. Indirect labor went from factory wages to overhead. Overhead applied then got applied from factory overhead account to our work in process inventory. Other overhead used then got put from other accounts into factory overhead. And then the finished goods, whatever we completed got moved to finished goods inventory, and then whatever we sold got treated as cost of goods sold. And so all the idea here, I know it looks like a lot. And they're showing how we can track it by jobs here, these job cost sheets on how it can all match up. And the idea here is really simple. Don't get too caught up in the numbers. We're just taking all we've talked about all today. Direct materials go into work in process if we're using it. Wages, direct wages go into work in process. Anything else goes into factory overhead. And then we're going to allocate factory overhead based on that rate to our work in process. And then that's it. And then if we finish it, it goes in finished goods. If we sell it, it goes in cost of goods sold. Super simple. And then anything that we missed, we're going to true up as an income or expense, as a revision to our expense and cost of goods sold. And this just shows the journal entries that we walk through in a summary format. I'm really not going to be testing on a ton of journal entries, but you need to know the reclasses. Okay, accounts payable. If we're buying raw materials, it goes into raw materials inventory. And if we use some of that raw materials inventory, we have to credit it and make work in process. If we finish some of that work in process, we have to credit the work in process and debit the finished goods. So this is all this reclassing that those costs until they become a cost of goods sold. And then this is a final schedule. This is what it looked like from a financial reporting standpoint. All those journal entries, all that flow, when finally summarized. And here's the materials we used, the labor we used, the overhead we applied, our total costs. We had no work in process at the beginning of the period, so our total cost is the same. And then we subtract what's left as work in process, and this is the cost of goods we built. And so the big risk we have here is our applied amounts, our estimated amounts can be different than our actual amounts. So we can over-apply and under-apply factory overhead, right? Because, and the reason we do that is just because our estimates are wrong. And that's what always happen. If we can estimate perfectly, then you're in the wrong job. You should be in the stock market and making bets if you can always predict the future. But most of the time we're gonna be off, 99.99% of the time. And hopefully we're just not off by too much. And so learn this chart that if our actual costs are greater than what we applied, we'll have a debit factory overhead balance because we'll have more costs than we actually applied. Because our overhead, we're debiting it as we incur these costs. As we apply it, we're crediting it. That means our overhead is under applied and the jobs are under costed. And we'll have to make an adjusting journal entry to cost of goods sold. But we're not going to be able to revise the jobs because they're already done. We'll just have to revise our next estimate. If our actual is less than applied, we overestimated, which means that our jobs were overcosted, which means we might have charged our customers too much. And then we'll have to make a revision downwards on cost of goods sold. So the risk here, some people might say, well, why don't we always just try to over apply? And then that way we always have more profit. Well, then you might lose some customers because your competitors might be able to give them better discounts, which don't make the profit margins they're looking for. And then that's just results in this following journal entry. This is one example. This is for under applied. If it was over applied, you'd flip it. But if it's under applied, you debit cost of goods sold because you didn't apply enough factory overhead, and you credit factory overhead. If it's under applied, you reverse it. You debit factory overhead, credit cost of goods sold. And then we talked about this. Service firms can do something similar. They don't have raw materials or finished goods. They might have supplies, but we have to worry about direct labor and apply overhead. We talked about that at the beginning of the class, how you would cost a CPA firm or a tax return. Any questions so far? Is this making sense? Is this completely off the chart or is pretty straightforward?
It's pretty straightforward. Thank you.
I know it'll be more helpful once you actually can see some of the questions, but the point of this lecture is for you to understand, get the basis, not to be too intimidated by the questions. Whenever you're like, some of the questions might ask for a lot of details, just try to go back to the basics. Just go back to my lecture, go back to the PowerPoints, watch the YouTube, and just realize, okay, it's pretty simple. We just have some costs and we're trying to figure out how to divvy up these costs into their own little buckets. It's just staying organized with the information. Anyone, any other questions? And something I'm gonna do for this class, because I think I found that Saturday students are generally just quicker at picking things up. What I'm gonna do, but I don't want to, and they're more time constrained. And so what I'm going to do for all of my classes, I want to cater to both groups. If you need more help, there's nothing wrong in that, but I'll stay extra for class and we can go over direct examples or direct questions. But if you're moving through this and understand it and quick, I don't want you to feel like you're trapped in the lectures because I'm going to give a lot of other resources to you. So I'll probably end the course early, and then students who want to stay longer, it's completely okay, and I can give you almost like one-on-one tutoring. So it serves the best of both worlds, hopefully. So I'm going to finish this lecture up.